Hello, I'm Tim Clairmont. Welcome to Clear Money Talk, where we turn complex financial topics into clear, practical insights.
And I'm Tyler Andrews. Welcome to the show. Today we got another fun one for all you listeners, and it's very timely.
Yay.
Topic of the day that we're talking about, Tim, is I want us to talk about how do wars impact the economy and your portfolio?
Well, it's timely now when we're recording this. I hope it'll still be timely when we release this.
Well, I'm sure we'll expedite.
Yeah, we might have to expedite this one.
I think where there's big things that are happening in the world, it's important that we talk about these things and discuss it. It's on likely everybody's minds right now, and I think there's some valuable insights that Tim and I will be able to share today with our experience dealing with these things in the past, as well as our perspective on it. Everyone's going to have a different perspective on it, and it's important to share those thoughts.
Yeah, I know, I agree. I think there are a lot of insights, a lot of curiosities, and certainly the market does respond in situations like this. I mean, you see the stock market change drastically. You see things like oil prices, move in a certain direction very quickly. In this case, significantly higher. You might be wondering why gas might cost you more at the pump, and the answer for that is just a quick FYI. If oil prices go higher, obviously the gas costs more. And why do oil prices go higher? Because the supply. It's all about, everything comes down to supply and demand. If the supply of anything shrinks and we don't have access to that, and the demand stays the same, the price goes up. And that's some good economics 101 stuff out there for you. But the bottom line is when you have less of something and everybody still wants that something, it's going to cost more to get that something. And that's a big part of what we see. The other part that we see is the lack of clarity around value. And we'll unpack that a little bit, because when you don't have clarity around value, it's really hard to price things correctly. And then you also see scarcity mentality, fear. War is scary. And so when you have that fear, that's very normal, very human, very emotional, it can affect the way that you look at everything, from the price of stocks in the stock market to the amount of goods that you hoard. You might be stockpiling things because you're really fearful that war is going to come into your own home, and if that's the case, you need to be prepped, and hence that prepper kind of concept mentality. You can see an increase in purchases of those sorts of things as well. Anyway, I'm sure we'll talk through a lot of it in a bulleted capacity, but that's my quick gut check.
No, I think that's great, and of course I bring some structure to the podcast so we can have some conversations here as far as it's concerned. And really, I mean, what I would love to open with is that when the headlines on the news shift from politics to missiles, markets often react before people have a chance to digest what's going on. But the real question becomes, do wars permanently change the economy and your portfolio, or do they simply test the discipline of you and your plan and your portfolio and how you react to it? I think that's a key thing to talk about on this show today, is the discipline behind it, which, as we've seen time in and time out, the people that remain disciplined are usually the people that come out on top. And without any guarantees, obviously, with that, but discipline is a huge part of financial planning. So, especially at times of uncertainty, as Tim was just mentioning. And wars bring a lot of uncertainty. How long is it going to last for? What's the global impact that's going to have? What's the impact it's going to have on your home turf, wherever you might be living? What's the impact emotionally? There's so many different factors that are going on and emotions that play with this stuff, and we take that very seriously. So. I think it's going to be maybe not a fun one today, but at least an educational one.
We'll try to make it fun. Obviously, war is not a fun topic, and I think we need to stay out of the political elements of that and the emotional elements associated with the political circumstances. This is bigger picture. This is bigger picture. Wars have happened over the years. This is not it's not the first war. We've had the Ukrainian war going on for a little while now. If you look back, there were several wars that we've experienced, and they've all had different impacts. In terms of lasting impacts, and yet they all have very similar immediate responses, and I think that's something we can probably speak to. I like what you said about the discipline of your portfolio. Does it just test it, or does it permanently change things? And I do think that with certain economics, there can be some permanent changes at the end. Whenever hopefully there is an end, right, to all of these wars. Things, when the dust settles and we can see clearly where things are at, and they look like they're getting back on a normal level again. I think most of the wars I've seen, that I've experienced in my lifetime, now 50 years old, coming up here in a couple months, it's things have gone back fairly similarly after the war, in terms of economics, in terms of the stock market, in terms of the financial elements. I'm not going to say they're the same by any means in all of the other social ways that things can change very permanently in that kind of an environment, but fundamentally, a lot of the basic companies that we rely on every day have been they're there before the war, they're there during the war, and they're there after the war, and how much they're worth is oftentimes not greatly affected in a massive way because of the war, and then there's a handful of companies that are more directly related to war circumstances, and they can have a temporary boost in their revenue or a temporary hit to their net profits during a wartime situation. And it's all of those little variables that go into creating the uncertainty that makes it hard for people to know how much is this stock worth, how much is this particular investment strategy worth, how much is gold worth, how much is oil worth. We don't know how much it's worth, and when you don't know, fear shoots prices in a scarce environment really high, and it shoots prices in a non-scarce environment, like regular stocks and stuff like that. People don't feel like they're scarce. Those tend to drop a bit when we're experiencing a time like this because people just don't know what they're worth, and they'll wait until they have better clarity as to what the value might actually be.
Mm-hmm, mm-hmm. And going back to the topic of the show is how do wars impact the economy and your portfolio? I would love to talk about these things in this order, Tim.
Sure, please.
The immediate market reaction. What happens immediately when a conflict arises? What does the economic ripple effects look like after maybe the immediacy of it happens, and then moving forward? What is some of the economic indicators and things happening there? What do those look like? A historical perspective, I'd love to talk about. A lot of what we do in this industry is looking backwards to say, well, if history has taught us anything, or historically speaking, based on what we have as far as data is concerned, and we have to use history to gauge a lot of this stuff as far as sentiment, strategy, a viable path forward, all that stuff. So talking about a historical perspective when it comes to wartime, I think is important. And the last thing is investor psychology during war times. So that way we can talk about some of the behavioral finance elements of investing when it comes to uncertain times where war is taking place. So the immediate market reaction is the markets are usually shaken up. I mean, we're seeing it right now. Today is March 5th. We've been seeing some volatility. There's no way to ignore it, whether you're watching the local news or the national news, or you're on social media, or you're talking to your buddy Joe. Joe, not calling you out by any means. People are talking about
whoever you're talking to.
People are talking about market volatility. You can't ignore it, and that usually is brought about, like Tim has said, with the uncertainty that follows with war. It's an uncertain time. How long it's going to last? What's the impact now versus tomorrow versus in the future? And all those different things. The equities will typically experience volatility during that time. A lot of the times that's price declines, not necessarily price inclines when it comes to the equity markets. Oil and energy prices may rise.
Before we move on, I agree with your point, Tyler, on the oil and energy. I feel like a lot of people know that the stock market tends to drop after a war situation occurs, but you might not understand why. And you're just like, oh, Tim, you're telling me, and Tyler, you're telling me the sky's blue. Like, I get that. Okay, you might feel that way. So let me see if I can unpack that for you a little bit. So stocks and the value of stocks. Now, any stock you want to consider, every company is the same. When you own stock, you own part of a company. And the companies all have basic factors that come into play. Revenue comes in, that's the amount of money they kept coming in. Expenses go out, the difference is profit. That's it. It doesn't matter what kind of company you're dealing with. You got revenue coming in, you got expenses going out, and the difference is profit. When you have uncertainty around whether or not the revenue is going to continue to come in at this level, or if the expenses are going to stay at this price, because they might change, go up, then that profit number fluctuates. And generally speaking, stock tends to trade at a multiple of earnings. There's something called EBITDA, which is earnings before interest, taxes, depreciation, and amortization. The point is, it takes a look at your net profit in the business, and then things will trade at what's called a PE ratio, price to earnings ratio. Typically on the larger companies, somewhere between 10 and 25. 15 to 18 is a pretty common number. So if you're trying to price the stock based on 15 to 20 times earnings, and you're assuming revenue is here and expenses are here, and you've done that multiplication to figure that out, and now you have uncertainty. You don't know if revenue is going to keep coming in at this level or if revenue might come down. You don't know if expenses are going to stay at this level or if expenses might go up. If that profit shrinks, that can have a massive effect on the value of that stock. So people don't want to buy stock in an environment of uncertainty like that. Instead, they'll just say, I'm not going to buy it unless it's so cheap that I think it's a good deal. So you see the stock prices drop because people are like, that's low enough. I'm pretty sure this company will get through that and probably be worth more than what that price is. And that's what happens when those stock prices drop. So hopefully that just gives you a little more clarity into the mechanics behind this. It's not because these companies are somehow magically worth less. It's just that people don't want to pay full price for these companies because they don't really know what they're worth in a situation like war.
Yeah, I think that's such a perfect visual to see when it comes to this stuff, and it hones in on the fact that market volatility is not about war itself. It's about the uncertainty that it brings about, how long it's going to last, and the major impact that it's going to have as a whole.
I didn't mean to derail you from the oil energy comments.
No, it's okay. We'll get back to that.
Yeah.
So I think we hit on the immediate market reaction pretty well. People are unnerved. There's lack of clarity, and that leads to volatility. The economic ripple effects can be a little bit deeper. So I'd love to talk about that. And that one of the biggest ones is energy prices and inflation. We can see those having a ripple effect from an economic standpoint, a macroeconomic standpoint there. Another economic ripple effects can be government spending and deficits, supply chain issues, interest rate policy. These are all things where different levers can be moved in the greater economy depending on where the war is hitting the hardest, if you will.
Let's unpack those, though, because from an education standpoint, let's go to the first one. You mentioned three. What was the first one you said?
Yeah, energy prices and inflation.
Energy prices and here. Oh, are you going to unpack that?
Well,
go for it, man. I want you to. I just didn't want to skip it.
I wanted to use an example.
Great, perfect.
I wanted to use an example.
That sounds great.
A good example is conflicts in the Middle East often affect oil supply expectations, right? Higher energy prices can influence inflation, which may impact central bank policy decisions. So there's kind of this whole trickle-down effect happening. If we're having conflict in the Middle East, which is where a large part of the global oil supply comes from, that is going to lead to supply chain expectations and issues. Higher energy prices can be influenced because of that. We're seeing that happening right now. I mean, a barrel of oil is skyrocketing as far as prices are concerned right now. And you're going to likely see that affected at the gas pump here soon, potentially.
Yeah. Well, let's talk real world. Inflation just means stuff's going up in cost, right? And so energy prices, we know, are increasing in this particular environment. So if the cost of oil, for example, goes up, and then the cost of gas goes up, we're all paying for more gas. When we look back and measure where inflation has been, the measurements are going to say, oh, everything's costing a little bit more. Thus, we have higher inflation. That causes a trickle effect, because the fact that we have higher inflation means the Fed is going to look at that and say, oh, that's scary. And normally when you have higher inflation, they're usually wanting to put pressure to raise interest rates because they're worried about inflation, going, taking off in a bad way and making it so that, every citizen can't purchase regular day-to-day goods. So it forces this temporary little bump. If it is temporary, and we'll see, but I anticipate usually it's temporary during the period of war. We just don't know how long. Temporary could be short, or it could be a long temporary experience, but it is still expected to be temporary. So during that period of time, you have higher costs, hence higher inflation, and you have the government needing to take action to address that higher inflationary environment. And that action, raising the interest rates, can actually put a damper on the economy, because according to John Maynard Keynes, Keynesian economics, when you increase interest rates, you slow the economy. When you decrease interest rates, you can speed up the economy. And we have a very interesting environment right now with the new Fed chair coming into play in May, and the anticipation of one or two rate cuts, hopefully later this year. Something like this, with higher inflation occurring, could potentially postpone those rate cuts or bring those rate cuts to a zero, or maybe even see a small rate hike. But this is probably putting some pressure on the likelihood of those interest rate cuts occurring. Whether that happens or doesn't happen, this is what we're talking about when we're talking about inflation. And those are real world things that will affect you. That's your cost at the pump. That's your cost when it comes to refinancing your house, or purchasing a new property, or refinancing the equity in your car, or dealing with credit card interest rates. I mean, these are things that will affect you on a daily basis, and it just means now might not be a bad time to think about locking in those rates if you were on the fence hoping for bigger rate cuts. I hope rate cuts still happen. I don't want to make any real short-term predictions on anything as volatile as interest rates or everything else, but just understand this is one pressure that's moving in the opposite direction against rate cuts, that when you see a war situation like this.
And I think a big scary word a lot of people think during these times is recession. And that said, historically speaking, not every conflict leads to recession. It doesn't automatically lead there. I think a lot of the context matters, the duration matters, scale matters, and all those factors weigh into those unknowns.
Yep.
So you want to talk?
There was another thing you mentioned that's actually on the plus side, that's a positive thing for the economy that actually could improve the economy in a war situation, and I think it's worth acknowledging that so that you don't believe that there's just this negative out there. Yeah, the stock market went down. Yes, we might see interest rates maybe level or possibly even increase instead of have rate cuts. Okay, those are clearly bad things that generally speaking none of us want to have happen, but they're probably going to happen. Not to mention the higher cost of the pump and all that other stuff, energy costs. On the good side, it's not necessarily good like to feel good morally, but from an economic standpoint, when the government deploys a lot of expensive military products, which we've seen, you might have seen some of the memes and some of the other stuff that's out there about how expensive some of the missiles are and things of that sort that we spend money on, not to mention the consumption of all of the military expense, then it's like emptying your pantry. You know, if you have your pantry and your pantry's full of a bunch of stuff and you eat your way through it and you now have an empty pantry, you need to go to the store and reload your pantry. That's what can happen. The government can say, hey, we just launched a bunch of our stuff and we need to go rebuild that. When they go rebuild that, if they decide they want to rebuild it, and they're not just getting rid of some old beans that they don't want back in their pantry again, but they're actually getting rid of something they want, maybe it's some good tuna or something, and, the tuna's gone and now they have to restock some tuna, then they're going to pay contractors to build that tuna and that to create that tuna for their pantry, which basically means construction of more military weaponry that has been deployed, or replacing some of those things that were in the pantry that have now been used. That translates to contracts. It translates to contracts coming from the government to individuals and private companies. Those companies now have increased revenue, which can increase their profits. So some of those companies will do better during wartime environments. And though you got to pay attention to it, you don't know how much more revenue is going to be. So you still don't have clarity around what real price and everything is worth. It's still definitely speculative in nature. But fundamentally, when you're looking at restocking that, back to Keynesian economics again, you increase government spending. And increasing government spending is a tailwind for the economy, because all of that money coming from the government going out to those contractors, and those contractors then paying the everyday people that work in those companies, they have more money and they can take that money and spend it in our economy, which tends to be a positive as far as the economic impact. And that tends to happen a little bit later, but you just don't know how long it's going to be before that pantry needs to get restocked. And sometimes they're restocking it proactively, immediately, as soon as they see the war situation go on. So that effect could take effect a lot faster, or it might be something that maybe they're just getting rid of the old beans that they have no intention of reloading into this pantry at all, and they're going to build new stuff with it instead. But
I like the pantry analogy.
Yeah, it wouldn't surprise me if you see some government spending increase. So
yeah. I mean, historically speaking, wars can be very profitable for all the different countries that can be involved. More spending is happening on different stuff, and whether that happens at the front end, the middle, or the tail end of it is kind of the unknowns, and that's kind of getting in the weeds too much. But it's more about wars can be profitable, and whether that's a driving factor for conflict or not, it is kind of what it is. So appreciate it.
It's really hard to say that, but we have to say it. It's true. Wars can be profitable for certain companies and certain individuals, and there's anyway.
We are strictly speaking from an economic finance perspective.
To be clear, yes.
So that's all this is. Let's hit on the historical perspective. Sure. I'm reading my notes here because I can't remember all this stuff.
It's a lot of good content. I hope this is making more sense to you now. That's the point, right? Because a lot of this stuff people talk about, but they don't really get it. And we're hoping that you get it after we talk to you and share this with you. Hence, Clear Money Talk. I mean, it's to give you clarity. So
that's right.
Go ahead, Tyler. What else we got?
Historically, markets have experienced volatility at the onset of war, as we talked about earlier, but often stabilize once uncertainty becomes clearer. The largest economic disruptions typically occur when wars expand globally or materially disrupt trade. Short-term declines have not automatically translated into long-term structural damage to diversified portfolios. So hitting back to the main topic of this show is how do wars impact the economy in your portfolio? Typically, short-term declines can be expected, which we were talking about earlier. But as far as long-term structural damage to diversified portfolios or strategies or alignment with your portfolio, all that stuff, typically there's less data to back that from a long-term perspective. So, the show is about giving you clarity on everything and also hopefully bringing you some peace of mind. Because I think a lot of people need that right now, is just to know that, yeah, this is scary, but I'm going to be okay at the end of the day. And that's where we talked about discipline. It's where we talked about sentiment. It's where we talked about unpacking some stuff that just seems too complicated. But at the end of the day, complicated things get overcomplicated for bad reasons. Sometimes we can dumb it down, if you will, and just be like, look, this is it. This is how the cards are laid out on the table, and this is how to hopefully make those cards work for you as best as possible. So that's all we're doing.
Yeah. Actually, what you just said, though, is on point about portfolios in the long run lasting through this environment is really, really important. When you think about any time anything causes the value of your stocks to go down in your portfolio, you look at your retirement accounts, maybe you have a 401k and you're looking at the value of it. It's not like money sitting in a savings account or a vault at the bank. You own part of these companies that we're talking about out there. That's what you own inside of a 401k that's invested in equity positions or stocks, or inside of an IRA or any other kind of investment account. Those companies' resale value is currently down because people don't know what they're worth, but you still own the same number of shares of those companies. And consequently, what do you know about stocks when you think about it? Everybody should know this. They know buy low, sell high, right? You probably heard that term before, buy low, sell high. And emotionally, what do? We often sell low and buy high, because when things are low, we get scared and those emotions cause us to sell our stuff. And we're selling it cheap and we're losing money. And then when things are looking great and the prices are high on everything, we're buying stuff because we feel great. And that's the opposite of what we know we're supposed to do. We're supposed to buy low and sell high. So what should you do in an environment when the values are low? As long as you don't need to sell really soon, it's not a bad time to consider buying some of those great companies that you felt good about for a long period of time. And as long as you're willing to hold them until the war's temporary experience is behind us. I don't know how long the temporary is, if it's a few months or if it's a few years, it could be a few decades. I mean, there's all kinds of situations. But I do think at some point the human race is going to live beyond this war, and these companies will, many of these larger companies that have been around for a while and whatnot are probably going to do okay in this environment, and they'll adjust once things settle down.
Yeah. That's great. It's just, we vibe on these things. It's like, I love what you're saying. It's like, it's all good stuff. I think a good way to end this subtopic of this podcast is that reactionary decisions during times of crisis often can lead to more damage than the event itself. Mm-hmm. So that's where the discipline comes in. That's where having clarity comes into play. And that's a nice natural segue into the last final part of this podcast I want to talk about is investor psychology during times of crisis and war. Fear is powerful, right? Fear mongering, it can drive us to make decisions that we otherwise wouldn't make because we might not be making the most rational decisions at that point in time because fear is a huge driver for those things. So during times of crisis and war, most investors are asking these types of questions. Should I move to cash? Should I be buying gold? Should I be buying oil and energy stocks? Is this the start of something bigger? Is this time different than all the times previous? Mm-hmm. These are questions even I ask myself. And they're not bad questions to be asking by any means. And I encourage you, if you have these questions, to ask them. Don't just harbor them. Mm-hmm. Sometimes getting it off your plate and just talking about it, whether it's just asking it or getting clarity from others, is very helpful. So it's important to be asking these questions. But temptation based on headlines is also very risky. And I think that's where I'm trying to go with this, is that the risk is locking in losses or chasing trends without clarity behind it.
Mm-hmm.
If you know what you're doing, that's one thing. But if you're chasing what the news is saying or what your neighbor Joe I talked about earlier is doing, not calling you out again, Joe, that can be risky because you
All
don't.
the Joes in the
know.
world are going to hate us.
You're like, what the heck,
That's
Tyler?
funny. That's funny. No, Joe, we love you, man.
Yeah, we do. You're a good guy, good gentleman, if you will. But that's the risk, is that chasing something that you don't know how it fits into your broader plan and your broader situation is the risk that it carries. So. Yeah. Tim, I know that you have some thoughts on that. I'd love to.
Yeah, no, the investor psychology is, I mean, it's almost every, I might even say every, it's just I hesitate to say every because that's such an absolute term, but I can't think of any exceptions to the every right now. Every failure I've seen in clients' portfolios has usually been tied to an emotional reaction that they looked back later and regretted. When you have an emotional surge and you decide to take action based on that emotional surge in your investment portfolio, that's the greatest opportunity for you to mess up. And unfortunately, a lot of those mess ups are not correctable later to the same degree. And I'm not saying that that's what you're going to do in this situation, but just understand that the financials and everything else out there are in fluctuation, and when they're in flux like this, you don't necessarily know where things are going to settle. So a lot of times making big decisions on an emotional feeling in times like this is a lot riskier than a more traditional long-term diversified type approach. And I just want to make sure that you understand the risk you're choosing to take if you make that decision, and that risk is there whether you get in or out of your portfolio. You might think you're de-risking your portfolio by getting out right now. That is not necessarily the case. You may actually be infusing more risk by leaving that portfolio because you may no longer have a growth plan that's going to keep up with inflation. And if your alternate plan, if you get out of the portfolio and you put it somewhere else, you need to beat inflation wherever that somewhere else is. And the savings accounts and the money markets and the CDs are not designed to beat inflation. So if you're going into those positions short term with money you're going to spend in the next 6 to 12 months, great. But if you're going into those positions with money you don't need to spend for 3 years or 5 years or 10 years or 25 years, that better not be a long-term play because you're going to lose to inflation in the long run.
Yeah, I want to end on that. I think my final note, closing note, because that was amazing, Tim. I appreciate that clarity.
Sure. Thanks, bro.
Yeah. Is that your plan should be strong enough that you don't need to rewrite it every time the world becomes uncertain.
Yeah. There you go.
And if you don't have a plan, well, maybe that's leading to your fear and your nervousness of what's going on. And if you do have a plan, you also need a plan for your plan not going to plan.
I like that. You need to plan for your plan, not going to plan.
Because things change quickly, whether it's health or circumstances or the geopolitically the world, whatever it might be. Yeah. We have to plan for all these things not going to plan. So that's why we have different coffers, different buckets, different strategies for every client, depending on their unique circumstances. And if you don't have a plan, you should probably get a plan, and then plan on it not going to plan, and have a backup B, C, and D.
And the word of the day is plan.
Plan. That's right.
So we need to do Adjust the Answer, though, in order to bring this home. And I know this has been a longer show than normal, but
I think it's good for the
hopefully it's helping people out. And I really hope that when we get through the Adjust the Answer, people just really decide to listen to the long version of the show, because I think there's a lot of good value there. Go ahead.
Take it away, Tyler.
Yeah, take it away, Tyler.
I like that.
Yeah.
Topic of the day that Tim and I talked about was how do wars impact the economy and your portfolio? We talked about what it is. War introduces geopolitical uncertainty. That can affect markets. It can affect inflation, energy prices. It can affect investor behavior and sentiment. We talked about some biggest trade-offs. Short-term positioning may feel safer emotionally, like going to cash or changing your investment strategy, but you can potentially be sacrificing long-term compounding and tax efficiency within your broader portfolio. Tim, you brought up a great point during the full version of the podcast, is that it can feel safe to be getting out of the markets into something safer like cash, but you can actually be increasing the risk of your broad financial plan by making that decision. And I think that's such a great thing to unpack, which we talked about in the larger version of the show. Staying disciplined may feel uncomfortable, but it can help preserve strategic alignment with your broader financial plan. One scenario where it all fits together is adjustments may make sense if your time horizon, your liquidity needs, your risk tolerance, or other things have materially changed due to life circumstances. But don't use wartime or crisis as the crutch for making those decisions. Take a step backwards, look at things holistically, and understand what you're doing before just jumping into any rash decision, because a lot of the times fear and risk force people to make decisions that they otherwise wouldn't make in times of more clarity. And times of war and crisis is times where there is lack of clarity. It's uncertain. We don't know how long it's going to last, how big the impact or how small the impact's going to be, and that forces and leads people to make decisions that they otherwise wouldn't make. So just remember that key fact there. And then making a wholesale portfolio change purely because of headlines without a change in long-term objectives usually doesn't make sense.
Yep.
So make sure all those things align with each other.
Yeah, let's restate really quick the question for the day, and then I want to add a piece onto the Just the Answer just for the benefit of everybody else. The question of the day is:
how do wars impact the economy and your portfolio?
Got it. So how do wars impact the economy and your portfolio? Tyler touched on a lot of really key takeaways here. You can usually get a lot out of our Just the Answer, and listening to the long show always gives you more insights, and it's fun. This is one where I highly encourage you to listen to the long version of the show, because there's a lot of good detail in there where we try to make things more, easier to understand. Clearly, when war occurs, the stock market has a tendency to go down. Energy prices can go up. You have some inflationary situations that can occur. That can create some pressure as it relates to interest rates. But understanding why all of that stuff works, and then why some stocks do so well, you'll have so much better clarity on that if you listen to the long version of the show. So I hope you enjoyed Just the Answer and get some good quick insights out of it. Bottom line is, it does have, I think, a significant short-term impact, but the biggest thing to try to avoid doing is don't let your emotions change your behavior on your plan in a short situation like this. Make sure there's some logic behind your decision making, and don't make the mistakes you're going to regret later.
Let's jump to some trivia.
All right, go for it.
You got to ask me a trivia question.
I do. I know. I think I've done it like once, but it's like,
the listeners want to see it.
All right, yeah.
They want to see, can you stump, not the nerd, because that's you, but can you stump the Tyler?
Oh, you sure you don't want to be a nerd? I think
I'm like a nerd junior.
I think you're, okay. Yeah. All right, that's fine. Go ahead. What do you got for us today?
All right, Tim, I'd like you to tell me which everyday invention was originally created to solve a problem during World War I. I got some options here for you.
Okay.
Option 1 is wrist watches. Option B, zippers. Option C is stainless steel. And option D is duct tape.
Oh, wow.
Yeah. It's not an easy one, man.
All four of those are really good.
Right?
Like, I can't even imagine not having zippers.
Can you imagine life without those things?
Or like, wristwatch, duct tape, stainless steel. I feel like the everyday problem element of that it kind of makes me want to come back to the wristwatch concept. But I feel like haven't wristwatches been around longer than that? But maybe not. Maybe that is about the right timeline. I'm just such a time junkie. I'm going to go with that one and just guess. So I'll say wristwatches, but I feel like zippers would have been really pretty critical as well. And stainless steel feels like it's not solving a day-to-day problem that was obviously very valuable, but then again, maybe it was stopping the rusting and stuff like that. But whatever. Really good choices. Really good question. I have no idea. I'm guessing wristwatches.
It's a great guess. Stainless steel is the answer.
Stainless steel is the answer. All right, there we go.
So a little bit of background. Stainless steel was originally created to solve a military problem. Engineers were trying to make rifle barrels more durable. And in the process, they accidentally invented something that now shows up in kitchens, hospitals, and buildings all over the world. So sometimes what begins in a period of conflict ends up strengthening everyday life in ways no one originally expected.
Oh, that's really cool. What a great way to finish.
Yeah.
Thank you so much for joining us today on Clear Money Talk. We know it's been a somber topic comparatively to some of our other ones, but we really value your time, and hopefully you got a good ROI on your minutes today.
Yeah, it was great spending time with you. If you found value in the episode, which we hope you do, please consider subscribing, sharing it with somebody that you think would also find value in it, and we look forward to seeing you on many future episodes to come.
Until next time.
Tim Clairmont and Tyler Andrews are investment advisor representatives offering securities through Cetera Wealth Services LLC, member FINRA SIPC. Advisory services offered through Cetera Investment Advisors LLC, a registered investment advisor. Cetera is under separate ownership from any other named entity. The views depicted in this material are for informational purposes only and are not necessarily those of Cetera Wealth Services LLC. They should not be considered specific advice or recommendations for any individual. For a comprehensive review of your personal situation, always consult with a tax or legal advisor. Cetera Wealth Services exclusively provides investment products and services through its representatives. Although Cetera does not provide tax or legal advice or supervise tax, accounting, or legal services, Cetera representatives may offer these services through their independent outside business. This information is not intended as tax or legal advice. All investing involves risk, including the possible loss of principal. There is no assurance that any investment strategy will be successful. Examples referenced are hypothetical only and do not represent the actual performance of any particular investments. A diversified portfolio does not assure a profit or protect against loss in a declining market. Bank certificate of deposits are insured by an agency of the federal government and offer a fixed rate of return, whereas both the principal and yield of investment securities will fluctuate with changes in market conditions. Clear Financial Partners is located at 15573 Bangi Road, Suite 100, Lake Oswego, Oregon 97035. For more information, please call us at 503-579-1000.